Good afternoon, everybody. I'm not sure what happened there with the start of the video, but welcome. Welcome to Liberty Call. It's Wednesday, May 18th, 2022. I'm a little early today, quite a bit late yesterday, so I'm making up for it today. So, beard sticking out the sides. Hope everyone's having a fantastic day. If it's your first time watching this amazing show of financial news and what's going on in the world, give me a thumbs up. I'd really appreciate it. It'd be fantastic. Also, like, share, subscribe, all that good crap. And I guess let's go ahead and jump in. Bloodbath today in the markets. Woo! Lots of a sea of red on this world market screen. So let's dive into see how things did here in the United States. The Dow Jones was down 3.57%, closed at 31,490. It was down over 1,100 points. The S&P 500 down 3.95%, closed at 3927. It was down 161 points. Nasdaq looks like it took the worst of the beating. It was down 4.73%, closed at 11,418. Small caps are also down 3.5%. The VIX climbed 18.7% today. It's up back up over 30 at 30.98. Moving down to the other Americas, Canada was down 1.9, Brazil down 2.47, Mexico down 2.14. Moving over to Europe, Germany was down 1.26, UK down 1.07, France down 1.2, the Euro stocks was down 1.36, Netherlands down the same, 1.36. One bright spot, Spain was flat at up 0.01%, so it was up 1 basis point. Italy down 0.89, Switzerland down 1.29. Portugal, also not too bad, finished down barely at 0.09. Belgium was down 1.13. Austria barely down at negative 0.04. Let's see, is that Sweden down 1.22. Denmark down 0.56. Got a few greens here. The MOEX out of Russia was up 0.87. The RTSI up 0.98. In Poland, they were up or basically flat at 0.06. And Hungary was up 2.36% today. All right. Moving down along. Turkey was flat at down 0.05. Israel down 0.43. Saudi Arabia was up 0.19. Few bright spots here in the Asian markets. Japan was up 0.94. Australia up 0.99. New Zealand up 1.29. Chinese markets were mostly red. The Shanghai was down to 0.25. The SESE component down 0.2. China A50 down 0.63. The DJ Shanghai down 0.3. The Hang Seng was up 0.2. And the Taiwan weighted up 1.5. So pretty ugly day here in the U.S. So it's wasn't much better in Europe, but we certainly took the beating here in the United States. All right, well, let's dive into today's market recap. S&P 500 slips as Rout in Target triggers a sell-off storm. The Dow down 1,200 points. The S&P 500 slumped Wednesday as big tech resumed its sell-off, and a Rout in Target following weaker than expected quarterly results triggered a sell-off in retailers. Target Corporation fell more than 26% after reporting first quarter earnings that were well short of estimates and cutting its guidance on margins, citing ongoing cost pressures. Lowe's Corporation also contributed to the gloom, falling about 6% after reporting mixed quarterly results as revenue and comparable store sales fell short of Wall Street estimates. The quarterly results sparked a sell-off in retailers, with Walmart, Costco, and Dollar Tree down sharply. TJX companies bucked the trend lower, rising more than 6% after the discount retailers' quarterly profit that topped estimates. Big tech pared some of their gains from an earlier day as investors continued to mull the prospect of the Federal Reserve turning more hawkish on monetary policy tightening. Fed Chairman Powell said on Tuesday the central bank would, quote, keep pushing, end quote, interest rates higher until the pace of inflation cools. Amazon and Apple led big tech lower, falling more than 7 and 5% respectively. Treasury yields, meanwhile, struggled to advance, pressured by safe haven buying as investors remain concerned about slow growth amid policy tightening from global central banks. Energy stocks were down more than 3% after oil prices turned negative as sentiment on risk assets and strength in the dollar weighed. Halliburton, Marathon Oil, and APA Corporation were among the biggest sector decliners, with the latter down more than 7%. On the economic front, housing activity continued to slow in the wake of rising mortgage rates. Housing starts, a gauge of U.S. home building, fell 0.2% in April on the month to a seasonally adjusted annual rate of 1.724 million. So yeah, not a lot of good news out there today. Yesterday was a bit of a reprieve. And like I said during yesterday's broadcast, don't let one day make a trend. And it looks like we're back on our downslope that we've been on for really since January. All right. Oil falls 2.5% as U.S. refiners ramp up output, equities retreat. Oil prices fell 2.5% on Wednesday, reversing early gains as traders grew less worried about a supply crunch after government data showed U.S. refiners ramped up output as crude futures followed Wall Street lower. Brent crude settled down $2.82 or 2.5% at 109.11 a barrel. WTI fell $2.81 or 2.5% to 109.59 a barrel. Both benchmarks gave up early gains of $2 to $3 a barrel following a change in risk sentiment as equity markets fell, said UBS analyst Giovanni Stonovo. Brent remained at an unusual discount to WTI a day after settling below the U.S. benchmark for the first time since May of 2020. Traders and analysts cited strong export demand and tightening U.S. crude stockpiles. U.S. crude inventories fell by 3.4 million barrels last week, government data showed, an unexpected drawdown as refiners ramped up output in response to tight product inventories, and near record exports have forced U.S. diesel and gasoline prices to record levels. U.S. gasoline prices fell 5% 2 days after touching a record high. Capacity use on both the East Coast and Gulf Coast was above 95%, putting those refineries close to their highest possible running rates. Quote, while on the face of it, the report is extraordinarily bullish, they, in parentheses, refiners, are racing to put more refined product on the market. There's obviously a refiner's response, end quote, said John Kilduff, a partner at Again Capital. The dollar strengthened and global stocks retreated on concerns about economic growth and rising inflation. Bearish sentiment also followed reports that the United States is planning to relax sanctions against Venezuela and allow Chevron Corp to negotiate oil licenses with the state producer PDVSA. Quote, the perception that we could see more supply coming from Venezuela, or the perception that we could see more supply Venezuela coming into the market. Wow. Who typed that? Along with equity markets is causing some profit taking in much needed technical correction in the crude, said Dennis Kisler, Senior Vice President for Trading at BOK Financial. The European Union's failure to persuade Hungary to lift its veto on a proposed embargo on Russian oil was adding price pressure, although some diplomats expect agreement on a phased ban at a summit at the end of May. Ongoing supply concerns remain supportive. Russian crude output in April fell by nearly 9% from the previous month. An internal OPEC Plus report showed on Tuesday as Western sanctions on Moscow curbed exports. On the demand side, hopes for further lockdown easing in China boosted expectations of a recovery. Authorities allowed 864 of Shanghai's financial institutions to resume work, sources said, and China has relaxed some COVID test rules for U.S. and other travelers. Well, that's certainly some good news that oil is receding slightly. I wouldn't get too excited because, until we get back in, I'd say, a $60 to $80 range a barrel, we really won't see much relief everywhere else. U.S. housing market cooling as building permits tumble, starts fail. So the housing market's got some slowing down. Permits for future U.S. home building tumbled to a 5-month low in April, suggesting the housing market was slowing as rising mortgage rates contribute to reduced affordability for entry-level and first-time buyers. But the report from the Commerce Department on Wednesday also showed a record backlog of houses still to be constructed, indicating the moderation in home building would be marginal. Home building was already being constrained by soaring prices as well as shortages of materials. The housing market is the sector of the economy most sensitive to interest rates, with building permits a leading indicator of the sector. Quote, housing construction appears to be undergoing a transition, with the sector caught between sharply rising mortgage rates and declining affordability on one hand, and supply chain constraints on the other, that continue to result in rising backlogs of projects, said Conrad de Castros, senior economic advisor at Breen Capital in New York. Building permits dropped 3.2% to a seasonally adjusted annual rate of 1.819 million units in April, the lowest level since November. They rose 3.1% on a year-on-year basis. Economists polled by Reuters had forecast building permits would decrease to a rate of 1.812 million units. The decline was concentrated in single-family housing segment, where permits plunged 4.6% to a rate of 1.11 million units, the lowest level since October. Permits for buildings with 5 or more units, 5 units or more, fell only 0.6% to a rate of 656,000 units. Housing market index dropped to the lowest level in nearly 2 years in May. Builders blamed the 5th straight monthly decline in sentiment on soaring prices for building materials, as well as rapidly rising mortgage rates. The 30-year fixed rate mortgage averaged 5.3% during the week ending May 12th, the highest since July of 2009, according to mortgage data from mortgage finance agency Freddie Mac. So I know some would say this is, a bad problem, but I actually see it as a good situation. If if the housing market slows down, that's a sign that, it is, the economy is cooling off with the higher interest rates, which is the purpose of doing that. So we'll see if the trend continues, or if, things go the other way sometime soon. All right. Wells Fargo sees end-of-year U.S. recession cuts its GDP view. So I am seeing a lot of articles of late talking about recession. I mean, whereas 6 months ago, they were saying, oh, no, everything's fine. It's just a little bit of inflation. And a year ago, this inflation is just transitory. Don't worry about it. It's no big deal. So more and more articles, and that's kind of a sign of where I see things whereas a year ago, I'm like, man, this is bad. We printed all this money. It's going to make everything more expensive. We're already seeing it. And, 12 months later, I look pretty smart. Hey. All right, let's dive into this one. Wells Fargo Investment Institute said on Wednesday it reduced its economic expectations with a mild U.S. recession now on the horizon in its best case scenario for the end of 2022 and early 2023, making it one of the more bearish big U.S. banks. Boy, that's a tongue twister. Goldman Sachs, by comparison, recently calculated the odds of a recession at 15% for next year and 35% for the next 2 years. Morgan Stanley's latest research shows a 25% probability of a recession starting in the next 12 months. Bank of America most recently said it sees recession risks as low for now, but elevated in 2023. Wow, that's some amazing forecasting. Wells Fargo research arm also cut its year-end 2022 gross domestic product growth target to 1.5% from 2.2% and cut its year-end 2023 target to a decline of 0.5% from its previous expectation for GDP growth of 0.4%. Its forecast a peak to trough contraction of 1.3% for 3 quarters. This would compare with the pandemic-induced 10% contraction in 2020, the 3.8% fall in the 2008 to 2009 financial crisis, and the 0.1% dip in 2001, and the 1.4% drop in 1990 and 1991. While a first quarter 2022 economic contraction was due primarily to strong imports and inventory changes, Wells Fargo noted that, quote, consumer activity has weakened since then, end quote. It cited the development of all 3 major risks identified in its December 2021 outlook, included the new COVID-19 outbreaks and restrictions, higher for longer inflation, and much stronger dollar. It said these issues were due to the Russia-Ukraine war and aggressive Federal Reserve policy. Yeah, you gotta wedge in that whole Russia-Ukraine problem to justify why things are falling apart. Quote, these shocks are taking an economic toll, end quote, it said. For its more bearish call, it cited the loss of momentum and sentiment among manufacturers and service providers. The University of Michigan's March consumer sentiment reading, its lowest since 2011, as well as broad-based declines in consumer activity and a series of sharply weak high-frequency economic data from mid-April to mid-May. The firm also cut its SP 500 target for year-end 2022 to a range of 4,200 to 4,400, from a range of 4,500 to 4,700, but kept its 2022 earnings per share estimate at $220 for the SP 500 companies. The firm also raised its forecast for U.S. Unemployment in 2022 to 3.8% from its previous forecast of 3.4%, and boosted its 2023 unemployment forecast to 4.4% from its earlier projection of 4%. But it kept its 2022 year-end consumer price index estimate, inflation estimate at 7.7%. So if they think that the S&P 500 is going to end the year between 4,200, and 4,400, right now, the S&P 500 is sitting at 3,923. And if most of these people believe that we're going to be heading into recession either late this year or sometime early next year, why would you think that the S&P 500 is even going to get back up to that 4,200 to 4,400 levels? So I mean, it's already, what was it, 39. So it's about 300 or 400 points off. And unfortunately, this seems like the beginning of problems, or the beginning of the slide, not necessarily. I just really don't see that rebound being working out in the long run. And another article, see, again, I'm trying to share these things that most of the time you're not going to hear on the news, and or it's going to get glossed over. It's titled "A Summer of Pain." The Nasdaq Composite could plunge 75% from peaks. S&P 500 could skid 45% from its top, warns Guggenheim's Scott Minerd. All right, the carnage playing out in the U.S. stock market Wednesday is likely a amuse-bouche. That's a tiny appetizer. I learned that in recent years. Compared to the devastation on the menu for bulls in the coming months and years, Guggenheim Partners Global Chief Investment Officer Scott Minerd told MarketWatch in an interview. The prominent CIO on Wednesday said he envisioned the possibility of a dreadful summer and fall for stock market investors, one in which the Nasdaq Composite eventually unravels, plunging 75% from its November 19th, 2021 peak. Currently, it's down 28%. The SP 500 tumbles 45% from its January 3rd peak, presently down 18% as we head into July. Quote, "This looks a lot like the collapse of the internet bubble," Minerd said, referring to the slow motion downturn of technology stocks in 1999 and early 2000. What's driving Minerd's pessimism? He fears that the Federal Reserve has made it abundantly clear that they are aiming to raise interest rates, despite the possibility that it could result in ructions in the equity markets and elsewhere. Quote, "What's clear to me is that there's no market put, and I think we're all waking up to that fact now," Minerd said. The CIO was alluding to the so-called Federal Reserve put option, which is shorthand for the belief that the U.S. central bank will rush in to rescue tanking markets, a notion that has been denied by previous Fed chairmen. Yeah, that's when, like I've talked about, if the Fed gets a yellow streak down their back at the first sign of any sort of problems or bumps along the road, if you see them start lowering interest rates well before, while inflation is still as high as it is, and start buying up toxic assets off the market, they call it quantitative easing. Then that these people are all cowards and all they're trying to do is save their jobs. Damn the consequences. Inflation forever. Let's see here. On Tuesday, Chairman Jerome Powell also appeared to try to disabuse investors of the notion that the Fed would be eager to throw investors a buoy as monetary policymakers attempt to combat an outsized dose of inflation. Quote, "Restoring price stability is an unconditional need. It's something we have to do," Powell said in an interview on Tuesday. Quote, "There could be some pain involved," Powell added. Minerd said he believed the Fed will continue to raise rates, quote, "until they see a clear breaking of the inflation trend and they are willing to go above the neutral rate," end quote, referring to the level interest rates that nearly stimulate nor restrains the economy. The Guggenheim executive said that a May 13th gathering of former Federal Reserve policymakers and prominent economists, including John Taylor, John Cochran, and Michael D. Bardo, hosted by the Hoover Institute just after the Fed's May meeting, caused him to take a more bearish stance on equities and the market as a whole. He said that he said attendees at the Hoover conference estimated the Fed would need to take interest rates to somewhere between 3.5% and 8% to hit neutral, which suggests to him that the U.S. central bank might need to dial up rates until something in the economy or markets or both breaks. The Fed appears to have, quote, very little concern about the continuation of what I think now is a bear market, end quote, Menard said. If that's the case, quote, we are probably going to have a pretty severe sell-off, he said. The investor said a severe downturn could give central bankers some pause, but any respite from hikes might not come until a lot of damage is already done. So as long as the sell-off remains relatively orderly and we don't get a sudden crash, the Fed is going to continue to raise rates higher than inflation, and unemployment will justify by the time they get to the neutral rate, he explained. Some Wall Street pros, including Wells Fargo chief executive Charlie Scharf, said that it will be hard to avoid a recession against the rate hike backdrop, and Menard agreed. Quote, when you start to line up all the data, a, quote, summer of pain is what we're headed for, end quote, he noted, adding that by October, things may have reached a bottom. In a draft of a research report reviewed by MarketWatch, Menard said, with the passage of time, the Fed continues to hike. We find ourselves experiencing the efforts of increasingly restrictive monetary policy. Well, before it reaches this terminal rate, the Fed will increase the risk of overshooting, causing a financial accident and starting a recession. Menard said that the Fed is heading towards over-tightening financial conditions just as unemployment shows some softness. So, again, we're headed for the abyss. And be careful. Now is the time to prepare, whether or not it's adjusting portfolios or making sure you have enough provisions at home in case of food. I mean, we're already seeing food shortages, in certain sectors. But if this gets really bad, I mean, most people are only a few, maybe a week before they run out of all their supplies. And, what are you going to do if the grocery stores are empty or it's a madhouse or, if worst comes to worst, there's, violence in the streets. Are you really going to want to head out to your local Kroger if there's gunfire? Probably not. You probably want to stay home. So, again, now's the time to prepare. It's just like, I said this all the time. It's like hurricane season, making sure you got your wood to put up over your windows already, drilled and ready to go, making sure you got your flashlights and batteries and, a radio or whatever you might need. I can't tell people what they need. They have to decide that for themselves. But the time to prepare is when things are still pretty good. And even though things are a mess, life hasn't fallen apart yet. And I hope I'm completely wrong. I hope I'm just being overly cautious. But in my profession, it's my job to look at the worst case scenarios and the best case scenarios and figure out which is more likely. And at this point, with everything that the government and the Fed has done, has really put us in a really tough spot and painted us into a corner where, unfortunately, we're going to have to just ride this out. So, all right. Well, hope everyone has a fantastic evening. I'll be back tomorrow with the Liberty Call for Thursday. And Astros kicked some ass last night, folks. They did pretty good. 5 home runs in the second inning. Gave me an opportunity to talk a little crap to one of my Boston friends from the Navy. She was getting kind of mouthy about it because they, beat us pretty good on Monday night. But I made a screen grab of the standings of each division, and that kind of shut her up. So, all right. Well, again, hope everybody has a great night, and I will talk to you guys tomorrow. Adios.